Hi, welcome to Market Minute. There are some critical fundamental reports, both on the economic side and earnings reports this week. The technicals are also at a very critical level. And when you sit back and look at all this, wouldn't it just be nice to get an 8% return until all this stuff is sorted out? So we're going to walk through that in particular. So the stock market. There's an old saying, it's stocks need bonds, but bonds don't need stocks. Meaning, right now in particular, stocks really need the bond market. But you can go in and get a really nice yield on bonds, and you don't have to worry about what's going on in the stock market. So this graph here just shows you, you can see here that the bonds have been rather ugly this year. The 20-year Treasury is down about 10% from the start of the year, and that's starting to impact the rest of the bond stock market. So as the bonds go down, the stock market has been rolling over with it. Now, we've talked a lot about this in the past, that the yield on the 10-year Treasury is becoming a problem, that the yield on the 10-year Treasury is almost equal to the earnings yield of the S&P 500. So that's becoming a big issue, and the stock market is waking up to that. You can see the green here is the S&P, the red is the NASDAQ, and the purple is the Russell 2000. So over the past 3 weeks, the S&P is down about 5.4%. The NASDAQ's fallen over 7, and the Russell 2000 off 8.5. So due to the high valuations in the stock market, interest rates on the 10-year Treasury in particular are critical for the stock market. Semiconductors. So this has been a really strong group, and it's a really important group as it is the leading edge of the economic cycle. So as the semiconductor goes, so does the overall economy. And last week we had ASML. These guys are a critical semiconductor equipment supplier to the high end of the semiconductor space. So if you're going to make any high-end chips like AI chips, you need their equipment. So it was rather disappointing to see that their order trends were off about 4% last week, or off 4% year over year in last quarter. So that the market got spooked by that. We shouldn't be seeing a slowing trend at this point in the economic cycle for this important equipment to build out these important chips. So also, the market got freaked out about the ASML report, and NVIDIA fell roughly 20%. So that's a big decline. That is a lot of market cap. So over the course of a week, roughly almost $1 trillion has come out of the Mega 7 stocks. So a lot of market cap came out of those large cap companies. Income stocks. This is a little more subdued, isn't it? And there's some opportunities. They look really interesting. Really worth taking some risk on. So agency mortgage bonds. So these bonds are backed by the government, and these are mortgages. So these are put into a pool, and they're backed by the federal government. So they're as good as treasuries. So as these yields expand on the mortgage bonds, so as the yields go up, it should not be much higher than that of a treasury note. So you can see here, this is the spread between the mortgage bond and a treasury note. And you go here 10 years. So 10 years, it's basically been about a 70 basis point spread between treasuries and agencies. That's what you would normally expect. Right now, the spread is about 154 basis points, so 1.5% above the treasury is the mortgage bond yield. So that's very attractive historically. And I have this on here so you can see it as well. So you can see it in really stressed periods. These yields do go up, but then they come right back down. These are really nice buying opportunities. So how to play this? The way I like to play it is I like to buy the mortgage REITs. So those REITs that focus on agency paper. So DX, I like Dynex. It is a very nice mortgage REIT, very conservatively managed. I like the management team there a lot. Yields currently about 13%. So what these companies do, they borrow money to buy roughly 8 times their capital to own these mortgage bonds, and so these agency bonds. So as they do this, they can offer really high yields, and agency, another mortgage REIT, yields roughly 16%. This is a high quality REIT as well. So when there's these opportunities in markets, these yields on these REITs really expand and provide income investors a nice opportunity. The technicals of the market, let me walk you through kind of a little bit of history here. So we broke above the 200-day back in November of last year, and we've got much more aggressive. We had a nice rally here. Our strategies got aggressive, and we got some turbulence here, which we did not like. So we broke below the 20-day moving average twice during January. And then finally, we got high enough above the 200-day, roughly 14%, broke the 20-day, and that's where we got a sell signal, full sell signal. So fully hedged roughly now 2 weeks ago. We broke through, as I mentioned, the 20-day and broke down below the 50-day moving average, and we're approaching the 100-day. So this is happening very quickly. So we're off rather nicely below the high, over 5%, as I mentioned, below the high. And I'm not sure. This might be some support here in the 100-day. So we'll have to see. But on a very short-term basis, we think the market's oversold, and there are some critical data. If the data goes the right way, we might trend back up to the old highs again. If it breaks, that's not far away from the 100-day. If it breaks below the 100-day, you want to get out and see how it manages the 200-day moving average. So on a very short-term basis, there's some trading here that can be done and make a little bit of money. The calendar looks ominous. So on Thursday, we get GDP. So GDP now is expecting roughly 2.9% GDP growth for the first quarter. And the deflator, so that's the inflation with it as well, is expected to be around 3%. So we're looking at around 6% nominal GDP relative to a 10-year Treasury at 4.6. That's too high. However you want to look at it, there's no room for the Fed to cut rates at this point. So 6% nominal, 4.6% a 10-year. The Fed is on ice. So on Friday, the PCE is reported as well. Remember, this is another inflation report. The Fed likes it. I like CPI. CPI is the real inflation indicator, in my opinion. But the expectation is for 0.3. That looks like it's going to be about right. And then that equates to about a 3.6% annualized rate of inflation for that inflation report. Now, the most important company to report in this cycle, in my opinion, is Microsoft. So they report on Thursday. The stock's pulled back, so there's an opportunity for it to rally into this report. But they have to deliver a good number, as does Google. Less so Google, but Microsoft is critical. So what we're looking at is if these numbers come in hot this week, hotter than that 6%, then the market's going to freak. The bond market's going to run those yields on the 10-year Treasury, likely above 5%, and we're going to see a nasty correction, if not a bear market. However, if the numbers come in a little light, a little softer than expected. And then Microsoft can give some guidance, maybe Google as well, to give more assurances that their earnings aren't going to really gravitate back down to what is normal anytime soon, that they keep that pace going, that 25 to 30% earnings growth, the market be really happy with it, giving some good confidence looking out to next year, and those numbers not rolling over down to that, say, 12 to 15%, which would be more normal. So the market wants to see more clarity on what's happening in these mega cap companies, mega cap technology companies, that they can sustain their growth and give a good outlook for 2025, or give some confidence in 2025. Now, wealth management. I want you to think about this a little bit. So it's pretty easy to look out, say, 18 months and have some confidence in what the outlook may be. It's difficult to do it on a short-term basis, and you could have a lot of confidence in looking out a number of years, generally speaking. But looking out 18 months, I can just tell you the expectations for $270 for the S&P 500 in earnings is total BS. That will not happen. So the optimistic case for the market, say we take the 270 down to $260 for the S&P and put a full multiple on that. It's assuming we get the rate cuts, the 10-year Treasury trades down to the mid to low 3% range. The S&P 500 should be up 10% from that level, 5,500 on the S&P. So that's a nice move. Our confidence in that happening is not real high. We're concerned that as rates stay high, we might roll over into a recession, or that the economy slows and that earnings don't meet expectations and the multiple's too high. So there's all sorts of things that can happen besides just the most optimistic or optimistic case for the overall market. Now, say you look at the 2-year Treasury at 5%. Well, 5% versus a maybe on a 10% sort of return. So you might get 10%, but you're sure of getting 5% out of the 2-year Treasury. You get your money back plus 5% each year. That looks kind of compelling to me versus taking the risk in the overall markets. However, we can construct an income portfolio that yields roughly 8%. So using baby bonds, we can find investment grade bonds there, triple B or better, that are 5 years or less in maturity, and then we can supplement that with some closed-end funds. Now we have to be careful there because those closed-end funds can be volatile, but they trade at a nice discount to their NAVs, which gives us some cushion. So if they trade off more than their NAVs, then there's some really nice downside protection in those names. But generally speaking, the closed-end funds don't do well in a bear market, but they have that nice yield to offset the decline. The mortgage REITs, as I mentioned, look compelling. We can get some really nice yields there, and the underlying asset class looks really strong to us. The blue chip stocks and some blue chip type of stocks, meaning quality companies, those stocks have all been kind of left behind, so we can find some nice yielding stocks out of those quality companies as well to put together a portfolio that yields around 8%, and if we need to, we can protect the downside. So an 8% yield with a little bit of wiggle to it versus the overall stock market to us looks really compelling. So just remember, we also like the biotech space, more so because of the stocks that we are looking at or own have significant events in front of them and have really big upside potential there as well. Now, on a short-term basis, we see maybe an opportunity here. Our tactical strategies have moved from being fully invested to being a little bit long, just a little bit long, and can expand that out if we do get some good data this week, or we'll have to pull that back to having no exposure if we get bad data and we break through the 100-day moving average. Thank you very much. Come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute, and we'll send that out to you every Tuesday. I want to tell you, it's important to sign up for the video on YouTube, because the emails are not all that reliable at times. They get stuck in spam or whatever else may happen to them. But the YouTube video is always there. Take care.